Two houses burned down in California in the exact same week, in the exact same neighborhood, same square footage, same blackened foundation by Tuesday morning. But what happens next is completely different. The first family has a household income of around $85,000 a year. They call their insurer and get assigned an adjuster. 2 weeks later, they get a partial check. 3 months after that, they're in a massive dispute over the depreciated value of their 14-year-old roof. Oh, and they get a letter informing them their policy won't be renewed next year. They are buried in red tape at the worst moment of their lives. The second family, worth around $6 million, calls their insurer too. But a dedicated private adjuster shows up the very next morning. Within weeks, they are offered a cash settlement up to their policy limits. No obligation to rebuild on that specific lot, no fight over the old roof, no non-renewal letter. Same fire, same state, same week. And somewhere else in the country, at this exact moment, a major health insurer is reportedly using an AI algorithm to reject medical claims at a speed of one denial every 1.2 seconds. You see, the biggest lie you've been told about insurance is that it's a single industry. It's not. It is a massive sorting machine. It's actually 4 separate industries wearing the same friendly corporate logo. And your bucket was decided before you ever filled out a single form. And today, we are walking up the American income ladder one rung at a time to show you exactly how insurance companies treat you at every single level. Hit subscribe if you've ever opened an insurance bill and felt your soul leave your body, because we're diving deep into the math they don't want you to see. Let's start at the bottom. Act 1. The poverty penalty. Low-income tier. I want you to meet Maria. Maria is a composite of about 30 million Americans. She's 34, single, has 2 kids, and works as a tech at a regional hospital in Phoenix. She takes home about $35,000 a year. Her credit score is sitting at 612 because a few years ago she had a medical emergency, ran up some debt, and is still digging her way out. She drives a 2014 Toyota Camry, and she has never had an accident in her entire life. Here is what happens when Maria tries to insure that Camry. In most states, insurance companies are legally allowed to charge you more based on your credit score. According to the Consumer Federation of America, drivers with poor credit pay an average of 115% more than drivers with excellent credit for the exact same coverage. Let that sink in. Same car, 0 accidents, twice the price. Your credit score was invented to predict if you'd pay back a loan. It is now being used to predict if you'll crash a car. And the scientific connection between those two things is basically 0. But it gets weirder. They also charge Maria more because of her job. Studies have shown that some insurers will quote a factory worker without a 4-year degree almost 90% more than an attorney with the exact same driving record. They charge her more because she rents instead of owns. They charge her more because of her zip code. And the kicker, there's a special bonus charge for Maria because she had a coverage lapse last year. Rent went up, she couldn't afford her premiums for 2 months, and now she is charged a fee for once being too poor to afford them. Maria ends up in what's called the non-standard market. You've seen these companies on billboards near payday loan shops. She pays $280 a month for state minimum liability, the weakest protection legally allowed, on a car worth maybe $4,000. She isn't actually insured. She's just legally allowed to drive. And we haven't even touched health and life insurance. Maria is likely stuck with a subsidized ACA bronze plan with a $7,500 deductible, meaning until she pays $7,500 out of her own pocket, her insurance essentially does nothing. Then she turns on the TV and sees commercials for a $1 a month burial policy. These are aggressively marketed to elderly folks in Maria's demographic. The companies ask vague questions, collect premiums for years, and when grandma dies, they conduct an exhaustive review of her medical history, find some unrelated mild hypertension she forgot to mention, and rescind the policy. The family gets a refund on premiums and a sympathy card instead of a payout. At Tier 1, every product costs more, is dramatically weaker, and is quietly designed to fail when you actually need it. Act 2. The middle class squeeze, $80,000 to $120,000 tier. Let's climb the ladder. You make somewhere around $80,000 a year. You drive a sensible car you paid off 2 years ago. You've got a 401k. You have health insurance through work, and you bought a starter home in 2019 before the housing market lost its mind. Welcome to the middle tier. And frankly, this is the most dangerous tier of them all. Here's the harsh truth about being middle class and insured. You have just enough assets to be worth suing, but not enough coverage to actually protect yourself. Your taxable savings and future earnings are wide open. If your teenager rear-ends someone on the highway and that person sustains a serious injury, a modern jury award can easily exceed $2 million, but your standard auto liability probably tops out at $300,000. Plaintiffs' attorneys literally pull your net worth before deciding whether to sue you. You are the perfect target. What you need is an umbrella policy. A policy that gives you an extra $1 million in liability coverage for just $200 to $400 a year. It's incredibly cheap and highly effective, but the insurance company that mails you a birthday card every year has never aggressively called you to sell you an umbrella policy. Why? Because it's actually a good deal for you, which means it's not a priority for them. What they will sell you is whole life insurance. A healthy 35-year-old can buy a 20-year term life policy with a $500,000 payout for about $30 a month. That same death benefit in a whole life policy between $500 and $700 a month. It's almost 20 times more expensive. Why? Because the agent's first-year commission on a whole life policy can be up to 110% of your first year's premium. They aren't lying to you. They're just heavily financially incentivized to nudge you toward the product that pays for their new boat. And then there's the middle-class health insurance. You have an employer plan with a deductible that makes you dizzy, and you have to deal with prior authorization. That's polite corporate speak for the insurance company gets to decide if you can have the treatment your actual doctor just ordered. Remember that algorithm we mentioned earlier, denying claims every 1.2 seconds? That's happening here. The middle class is being systemically squeezed, paying high premiums for a system that actively fights them when they need it most. Act 3. The high net worth heaven, $150,000 to $5 million plus tier. Now we hit the upper middle class. You're making $150,000 to $300,000. You're a senior engineer, a partner track lawyer, or a dual physician household. Suddenly, the insurance industry is incredibly polite to you. Your auto insurance is highly competitive because your credit is pristine. You have a primary care physician at a concierge clinic where you book on an app and they actually remember your name. This is the tier where someone finally mentions an umbrella policy to you. But let's go one rung higher. Let's look at the true high net worth tier, over $5 million in net worth. Welcome to the version of insurance that only exists in glossy brochures. At this tier, you don't buy your homeowner's insurance from the cartoon animals on TV. You buy it from Chubb, AIG Private Client, or Pure Insurance, brands that don't advertise during football games because they don't need to. If your $3 million custom home burns down, you aren't fighting over roof depreciation. These policies offer guaranteed replacement cost. Even if construction costs have spiked 40% in your area, they rebuild it fully. And here's the craziest part. Many of these elite policies have a cash settlement option. If your house burns down, you can just say, you know what, I don't want to rebuild. You can take a check for the massive policy limit and just walk away. Move to Aspen. Go buy a yacht. That option does not exist on a standard middle-class policy. When you make a claim, you don't dial a 1-800 number and sit on hold for an hour. You call your adjuster's personal cell phone. For healthcare,
They use concierge medicine services that cost $24,000 a year, where a doctor only has 50 families on their patient list instead of 3,000. They have 24/7 access to private urgent cares with on-site CT scans. If they need a procedure, they don't fight with prior authorization, they just pay cash. They use health insurance the way large corporations do, strictly as a backstop for catastrophic events they hope never happen. Life insurance? It isn't about burying grandma, it's functionally a massive estate tax loophole. In 2024, a Senate investigation estimated that one specific high-end life insurance product was being used to shelter up to $40 billion from inheritance taxes. Same legal terminology on the paperwork, completely different universe of wealth protection. How to beat the system? Let's zoom all the way out. The exact same industry will quote a single mom $280 a month for minimum liability on a 14-year-old Camry and quote the exact same $280 a month for full coverage on a brand new Tesla. They will exhaustively review a senior citizen's medical history to deny a $10,000 burial policy while selling a hedge fund manager a $20 million tax loophole. In 2024, the property and casualty insurance industry posted around $170 billion in net income. The CEOs took home tens of millions, and the people getting denied, dropped, and squeezed were almost entirely in the bottom two tiers. So, what do you do about it? Individually, you can't rewrite the laws, but you can change how you play the game. Stop letting your auto insurance auto-renew. Loyalty is a tax. Shop your rates every 2 years. Stop buying whole life insurance at the kitchen table. Buy term life and invest the rest of the money yourself. Buy the umbrella policy. If you have a house and a 401k, spend the $300 a year to protect yourself from a catastrophic lawsuit. Read your homeowner's policy. Find out today if it pays actual cash value or replacement cost. That one sentence will make or break you if a tree falls on your house. But the absolute most useful thing you can take away from this video is a mindset shift. Insurance is not a relationship. It is a legal contract. They do not love you. They never did. The wealthy figured this out a long time ago. They treat insurance like the cold, adversarial, transactional product it actually is, and they manage it like a CFO. The rest of us treat it like a friendly neighborhood service with a smiling mascot, and we get taken advantage of accordingly. Stop confusing the mascot with the company. If you want to protect your family, you have to know exactly which industry you are actually buying from. Thank you so much for watching. If this video helped you understand the financial world just a little bit better, drop a like, hit subscribe, and share this with someone who needs to hear it. I'll see you in the next one.